This is much more dangerous than you think. Central banks eased in September 17th, while risk assets went vertical into October 21st. That's a contradiction. It's also a signal. Here's the context. When policy drifts easier while valuations stretch, markets aren't pricing productivity, they're pricing liquidity. The last time this pairing persisted was 1998 before the dot-com crescendo. Different technology, same incentive math. The mechanism is simple. Cheap credit pulls capex forward. Balance sheets lever up. Earnings lag the narrative. Then one policy nudge exposes the duration mismatch. The arithmetic doesn't care about the story. It never has. Here's what's actually happening. Alphabet, Amazon, Microsoft and Meta are spending $300 billion in 2025 on artificial intelligence build-outs. That single line is about 1.2% of United States GDP. Issuance shows the plumbing. US tech firms floated roughly $157 billion in new bonds this year, about 70% more than last year. Oracle carries close to $90 billion in total debt and keeps adding each quarter. Microsoft's stack jumped from 27 to 46 billion within a year. Meta added tens of billions since 2022. These are world-class franchises. The signal isn't quality, it's funding. When the cost of money sits near 4 to 5% and cash flows from new projects are uncertain, leverage turns from accelerator to amplifier. History rhymes. In 1996, 1997, and early 1999, corporate America spent aggressively on internet infrastructure. The Nasdaq 100 surged into March 2000. Then policy tightened, and the air pocket appeared. 80% of index value vanished from the 1999 peak to the 2002 trough. Different tickers today, same reflex loop between credit and hopes. Now the contradiction that keeps showing up. Productivity anecdotes are real at the desk level. Drafting emails, summarizing notes, generating quick first drafts. Adoption is widespread inside firms even when budgets say pilot. But the near-term corporate return on massive generative deployments remains ambiguous. One study this year estimated that a very large share of corporate AI investments, north of 90%, have produced little to no measurable return so far. That gap between promise and P&L isn't a scandal. It's a timeline problem. Capex is now, payoff is later. Debt clocks don't wait. Micro cracked. Macro decides. Policy frames the window. On September 17th, the Federal Reserve set the policy range at 4 to 4.25%, while still describing inflation near 3. The Treasury keeps rolling trillions at rates that are twice the 2021 coupons. Translate coupons. A coupon is the interest rate paid by a bond every year. Translate real yield. The yield minus inflation. The true cost of money. Translate auction tail. The amount by which a Treasury auction clears above the expected yield. Bigger tails imply weaker demand. Scale matters. Net interest costs in fiscal 2025 moved above $1 trillion on an annualized basis, surpassing major program lines. That's more than parts of defense outlays at points this year. Every 1 percentage point higher on term structure ripples through refinancing calendars for agencies, municipalities, and corporates. The rollover math is relentless. So what's the danger? It isn't the technology, it's the funding loop built around it. When debt finances capacity that depends on perfect adoption curves, small policy tweaks become system shocks. Step 1. Issuance concentration. Investment-grade calendars showed tech and communications dominating new supply in multiple months this year. Primary dealers happily distribute when spreads are calm. Calm can be a trap. Step 2. Maturity walls. A thick band of corporate maturities arrives in 2026 and 2027. If policy holds near 4.25 into that window, coupons reset higher. That compresses buyback capacity and pushes firms to defend margins. Step 3. Policy variance. One surprise hike or even a pause where markets priced faster cuts can widen credit spreads by 50 to 100 basis points in days. That reprices everything from data center riots to equipment financiers. It also hits equity multiples that assumed investment was free. Now zoom out. The European Central Bank still sits with policy rates above 3 into autumn. The Bank of Japan toggled away from yield curve control and continues to test a stronger floor for yen. The People's Bank of China leans supportive, but remains constrained by property sector deleveraging. These aren't side notes. global money conditions translate directly into the cost of capital for multinationals sourcing chips, power, and servers across borders. Look at energy and power as a constraint. Large language model training runs drink electricity. Regions with power shortages have already delayed projects and renegotiated timelines in 2025. When megawatts collide with credit spreads, the bottleneck shifts from silicon to substations. That's a system constraint, not a marketing problem. Here's a clean mechanism map. Capital in, corporate bonds, structured leases, and vendor financing fund racks and real estate. Dollars out. Depreciation schedules and power contracts lock cash flows for years. Revenue in, subscription-like AI features, and usage-based inference billings that may trend lower per unit as competition rises. When price per token falls faster than cost per watt, operating leverage flips. If real yields rise while that flip happens, the pain compounds. The historical parallels aren't a prediction, they're a compass. 1986 to 1987 saw corporate leverage rise into a policy shift. A sudden rate bump and a valuation reset followed. 2012 to 2013 delivered the taper tantrum as the Federal Reserve signaled a slower balance sheet expansion. Long yields jumped and duration trades unwound globally. 2015 to 2016 combined a dollar surge with commodity stress. Capex in energy froze and defaults ticked up in high yield. Each time the technology or commodity wasn't bad, the financing terms changed. So where are we on the curve now? Semiconductor baskets went parabolic into October 21st. A day later, a more than 5% drawdown flashed that liquidity can reverse faster than narratives. At the same time, the 10-year Treasury hovered near 4 to 4.5% through the week. That's the picture of policy gravity reasserting itself while momentum still believes it can float. Record, then recoil, then reveal. The players and their incentives matter. The Federal Reserve targets inflation near 2 while managing financial stability. It cut earlier this year to 4 to 4.25 to balance growth risks against sticky services prints near 3. The US Treasury must refinance and fund deficits that cleared $1.7 trillion in fiscal 2025, with outlays above $7 trillion and receipts around 5.25. Auction schedules, including 3-year, 10-year, and 30-year lines in November and December, test appetite. Watch the tails. The Securities and Exchange Commission keeps scrutinizing non-GAAP adjustments and capitalized costs in emerging AI lines. Small changes in accounting treatment can compress reported margins. On the corporate side, giants lead. Microsoft's multi-year commitments to compute capacity exceed tens of billions. Oracle tied itself to hyperscale demand while carrying heavy debt. Alphabet and Amazon built their own silicon roadmaps to defend gross margin. Nvidia sits at the center with supply allocations and guidance cadence. Sovereign wealth funds have rotated capital into infrastructure partners, betting that picks and shovels win, even if specific apps churn. Now the calendar spine that actually decides direction. There are 3 dates that matter more than headlines. First, the next Consumer Price Index print lands mid-November. Second, the next Federal Reserve meeting hits early December. Third, the quarterly refunding auctions notes and bonds span the first 2 weeks of November. That countdown repeats because it's the fuse. CPI, Fed, auctions. Say it again later, CPI, Fed, auctions. Why those 3? CPI shapes real yields. The Fed meeting sets policy path and dot expectations. Refundings test whether global savings still absorb United States duration without bigger discounts. If any one of those goes soft, hot, CPI, hawkish hold, or sloppy auctions, the snap you saw won't be the last. Here's the cliffhanger. If December delivers a hawkish surprise while November refundings tail and CPI runs firm, the cascade across duration-sensitive tech will be fast. If instead CPI cools, auctions clear firm, and the Fed signals patience, the melt can resume into year-end. Which path prices in? That's the whole game. Let's define the 3 tells promised at the open. Watch issuance, mix, and spread. If investment-grade tech supply stays elevated while spreads stop tightening, it signals saturation. That's when marginal buyers demand more compensation. If spreads widen 50 basis points while issuance remains high, funding pivots are near. Track real yields against power costs. If 5-year real yields rise while grid prices stay high, operating leverage deteriorates for compute-heavy businesses. That's the signal that payback periods are stretching beyond boardroom patience. Follow auction tails and foreign participation. If 10-year and 30-year auctions tail by more than 2 basis points, repeatedly, and indirect bidder shares fall, the Treasury's cost of term funding rises. Everything else reprices off that gravity. Now the echo's restated as a scorecard before we close. Auctions, firm or soft. Real yields, rising or falling. Central bank flows, adding or pausing. Back to mechanism one more time. Why is this more dangerous than it looks? Because success can worsen the constraint. If adoption accelerates, capacity orders surge. That pushes more issuance into the market. If policy doesn't keep easing, coupons climb, and the same growth story tightens its own throat. That's reflexivity. It's elegant on a whiteboard and brutal in a refinancing calendar. Consider Europe. The ECB's balance sheet has been shrinking. If inflation surprises on the upside there while growth stays weak, rate cut paths get shallower. European corporates funding dollar-denominated projects will feel that in cross-currency bases and swap costs. Japan is similar in a different direction. If the Bank of Japan tolerates a stronger yen to stabilize import costs, US investors may see translation headwinds on overseas earnings even as hedging costs shift. None of this kills AI. It just changes the price of money that powers it. A brief translation check, plainly. Coupon, the interest rate a bond pays each year. Real yield, the bond yield after subtracting inflation. How expensive money really is. Auction tail, when a Treasury auction clears at a higher yield than expected. Bigger tail equals weaker demand. So what's next? 3 forward dates again to lock the spine. Mid-November CPI, first half November refundings, early December Federal Reserve. Between those, watch earnings calls for capex guidance and depreciation lines. Listen for power procurement commitments in megawatts, not adjectives. When executives shift from build to sweat the assets, the regime is turning. One last historical mirror. 2009 to 2011 saw a surge of smartphone capex and app explosions. The winners didn't just ship hardware, they owned the platforms that monetized usage. Today's analog is the compute allocation layer and the firms that control pricing power over access. If pricing power slides while funding costs rise, the outcome rhymes with earlier resets. Not the end of technology, just the end of a narrative that borrowed too far forward. Record, recoil, reveal. The closing thought is system level. Markets can price miracles for a while. Policy eventually prices math. The dangerous part isn't that the future won't arrive, it's that the bill arrives first.